Feeling like Canada is taxing you out of your own future? What if I told you that nearly 100,000 Canadians are legally escaping crushing tax rates while keeping their Canadian citizenship? What if you could reduce your tax burden to single digits, stretch your Canadian dollars 3 to 5 times further, and escape the growing burden of sky-high rent and ownership costs in cities like Vancouver and Toronto? Hi, I'm Reza from Ingwe Immigration, a global mobility firm helping Canadians and international clients invest, live, and thrive around the world. At Ingwe, we guide people like you through complex decisions, like relocating or restructuring your life abroad, so you can move forward with clarity, confidence, and financial peace of mind. Today, we're unpacking one of the most transformative decisions a Canadian can make: how to become a non-tax resident and why thousands are already doing it. Right now, Canadian citizens face some of the world's highest tax burdens. Marginal tax rates reach 53.5% in some provinces. The average home price has soared above $700,000 nationally. Meanwhile, average rent in major cities exceeds $2,800 per month. These crushing costs are driving an unprecedented exodus of nearly 95,000 Canadians in recent years, according to Statistics Canada. But here's what most people don't realize. You don't need to give up your Canadian citizenship to dramatically reduce your tax burden and improve your quality of life. The solution lies in understanding how Canadian tax residency actually works and implementing a strategic plan to become a non-tax resident while maintaining your passport. So, how does Canadian tax residency work? Here's the critical insight most Canadians miss. Simply buying a plane ticket doesn't change your tax status with the Canada Revenue Agency. Canada operates on a residency-based tax system, meaning residents pay tax on worldwide income while non-residents only pay tax on Canadian source income. The CRA doesn't care about your passport, they care about your ties to Canada, and their determination process focuses on 2 critical categories of connections. Primary residential ties carry the most weight. These include your home in Canada, whether owned or rented, your spouse or common law partner's location, and where your dependents live. Secondary ties add up over time and include personal property, social and economic connections, Canadian driver's license and health insurance, professional memberships, and financial accounts. But what does it take to become a legitimate non-tax resident of Canada? Let's walk through the step-by-step process. Becoming a legitimate non-tax resident requires methodical planning. First, you must understand the 183-day rule. Stay in Canada for fewer than 183 days per tax year, and remember that any part of a day counts as a full day. If you arrive at 11:59 p.m., that counts as day 1. Next, you must systematically sever your Canadian ties. This means selling your Canadian home or establishing arm's-length rental arrangements, relocating your spouse and dependents abroad, closing or minimizing Canadian bank accounts, canceling provincial health coverage, surrendering your Canadian driver's license, and ending professional memberships. Simultaneously, establish new routes abroad by securing permanent accommodation, obtaining long-term visas or residency permits, opening local bank accounts, joining local communities, and acquiring local licenses and health coverage. Then complete the official notifications by filing Form NR73 with the CRA, submitting your final departure tax return, and informing all Canadian payers of your status change. Let's now see the tax implications of becoming a non-resident. As a Canadian non-resident, you'll still pay 25% withholding tax on most Canadian source income, though this can potentially be reduced through tax treaties. You'll also pay capital gains tax on Canadian real estate sales and regular income tax on any Canadian employment or business income you maintain. However, here's where the real savings begin. You will no longer pay tax on foreign employment income, tax on foreign investment gains, tax on foreign rental income, or Canadian tax on your worldwide income. This is the game-changing difference that creates massive savings opportunities. Remember, when you leave Canada, the CRA deems you to have sold certain assets at fair market value, potentially triggering immediate capital gains tax. This affects publicly traded securities, private company shares with some exceptions, and certain other investments. However, real estate and registered accounts like RRSPs and TFSAs generally receive different treatment, so proper planning is essential to minimize this impact. So beyond understanding all these tax implications, what are some of the most common mistakes Canadians make during this process? Avoid the snowbird trap. Spending winters abroad while maintaining your Canadian home doesn't establish non-residency. The CRA sees through seasonal arrangements. Don't make the mistake of insufficient tie severing. Keeping your Canadian home just in case while claiming non-residency is a major red flag that often results in costly reassessments. Recent tax court decisions have clarified important principles. The Martin versus the King case in 2024, involving former Blue Jays players Russell Martin and Josh Donaldson, reinforced that Canada cannot tax non-resident foreign source income. These precedents strengthen the legal foundation for properly executed non-residency strategies. Now here's an extra tip that could save you even more. Canada has tax treaties with over 90 countries that can significantly reduce your withholding tax burden. Popular destinations offer attractive rates. The UAE offers 0% on most income with no withholding tax treaty. Malta provides 15% on most income types. Italy offers 7% on foreign pensions if you reside in an Italian town of less than 10,000 population, and Panama has a 0% on globally sourced income. For business owners, additional opportunities exist through establishing foreign holding companies, utilizing tax-efficient dividend structures, and considering intellectual property licensing arrangements. However, when you leave Canada, you'll generally be deemed to have disposed of Canadian company shares at fair market value, potentially triggering capital gains tax. So what is the conclusion? The numbers driving this Canadian exodus are clear. Popular expat destinations offer 50 to 70% lower cost of living, better climate year-round, powerful tax incentives, and growing international communities in countries like Panama, Portugal, Italy, and Cyprus. Unlike many bureaucratic processes, becoming a Canadian non-tax resident has no formal waiting period. Success depends on proper planning and meticulous record keeping, not government approval. Given the complexity and high stakes involved, professional guidance is essential. At Ingwe Immigration, we specialize in global residency and citizenship solutions, helping Canadians navigate the complex process of international tax optimization. From golden visa programs to crypto-friendly jurisdictions, we provide the expertise and connections you need for a successful transition. Contact us today to discuss your specific situation and discover how we can assist in your journey to tax optimized living abroad.